Welcome to the CodCast. I'm Chris.
And I'm Matt.
And this is the Silver Edition.
Happy New Year, Chris. 2026, all shiny and new.
Dad jokes.
Yeah, this was your idea.
It was Tom's idea, one of our shareholders, and we've just implemented it with Coda's usual aplomb. But with that note, we're going to talk about silver today, so happy silver.
That was louder than I expected.
It was loud. Shall we clean it up?
I think we should probably...
Clean it up. Matt, silver.
Silver.
Bit of a Christmas break. Mm-hmm. Silver and copper, let's be honest, but the commodity prices have been going absolutely crazy. We did our last study in September. That wasn't very long ago when we put our most recent economics out. We were at $30 an ounce silver. Mm-hmm. We did our sensitivities at plus or minus 20%, which with hindsight probably wasn't enough. First study was out at about $21 an ounce. And as of this morning, we're talking $85, $86 an ounce.
Yeah, it's gone absolutely crazy.
What on earth's going on?
Lots of stuff. Look, long-term fundamentals, supply and demand. Silver production has kind of tracked along sideways, gone down a little bit over the past decade or so, but demand has really only gone up. Industrial demand is a big part of silver. It's not a pure store of wealth the way other precious metals are. Something like gold, yes, it does have some applications. It's in some electronics. It's in some high-end audio gear, that sort of thing. But in reality, I don't know the number off the top of my head, but massive percentage of it gets turned into bars, stuck in vaults, or into jewelry. It's a store of wealth. Copper is on the other end of that spectrum. It's pretty much a pure supply and demand industrial play. It's used in stuff, it's mined, it's popped into electronics, into power, into electric vehicles, whatever it's used for. But it's not really, you don't see many people walking around with copper jewelry outside of a little bit of rose gold here and there. Silver sits in the middle. It's got massive industrial applications. It's in electronics. It's critical in solar panels, which is obviously a big long-term demand driver. But it is turned into jewelry. It is turned into coins and bullions and chucked into vaults, and it is a physical store of wealth. So it's a real hybrid between those two, and it's hard to tell sometimes what's driving the price change. So if you think about it from a supply and demand point of view, it's probably not driving this spike.
No.
We haven't seen any massive silver mines shut down. We haven't seen any new technologies demanding tons of silver all coming online at once. It's long-term upwards pressure, but it's probably not driving the spike over the past few months.
Yeah, and as I understand it, there's been, obviously there's a lot of financial instruments and derivatives and all sorts of things that are based off silver, but there's also been a pretty strong call on actually saying, hey, we want the physical silver. Yeah. And there seems to have been a mismatch between that's really pushed the price up as well, because at the end of the day, you do still need that physical silver for solar panels and industrial uses and everything else, right?
And that's the question, is it driven by financial or is it driven by industrial? I think at this point we can pretty confidently say that there's a big financial component to this demand spike.
But there's also been a mismatch between the silver and gold ratios, hasn't there?
Yeah, that's something you can actually track historically. Silver and gold typically fall between a ratio in their values of about 50 to 80. So you need somewhere between 50 to 80 ounces of silver to buy 1 ounce of gold in a normal market. And that ratio was tracking along. But as the gold price spiked over the past couple of years, which I'm sure anyone watching this is well aware of.
Probably familiar,
the silver price didn't track it up. And that gold-silver ratio hit, near as makes no difference, 100 to 1 in May, which was just before the silver price started to spike.
Yeah.
So that's probably one contributing factor. It's people for whom gold has gotten a bit overvalued, and people have gone, well, look at these other precious metals. They are not following gold, but all the same precious metal demand drivers should be driving them. And of course, they did.
Yeah.
Silver is now sitting somewhere around, depending on the exact ratio that you're looking at, somewhere close to that 50 to 1 mark.
Yeah, which is historically much more typical. In keeping.
Yeah. And I think at $4,500 gold, silver should be somewhere between about $56 an ounce, that's US, and 90. And so we're well within that bound now.
And we're at the upper end because potentially that's to do with industrial use, potentially is just part of the correction.
Yep.
But there's no doubt the silver assumption should be higher. All right, let's talk about two things quickly. First is, what does it mean for Coda? Because again, it's not the Elizabeth Creek Silver Project. We're not those people. You're not about to see a name change. It's been the Copper Silver Project for a while. So as a percent of revenue, it's roughly, in the last study, about 16% as silver.
Sounds about right,
Yeah. And again, I don't think we published these numbers separately, but as you pointed out when we were sort of talking about this episode, we did publish how much silver we expect to produce over life of mine, and you can times that by the silver price.
Yes.
So what numbers did we come up with in terms? So at the time, about 16%. Silver's gone much higher at the moment. So we've gone from about 900 million Aussie dollars worth of revenue.
Yeah, so it was 20.3 million ounces over the life of mine. Yep. Do the maths, that's about 900 million Aussie.
Yeah, at $30 an ounce.
At $30 US an ounce. And obviously, we're at 250% of that now. So it's not hard to do the maths. It comes out about 2.25 billion if we just did nothing else and just take out the 30, pop in the 85. That's the sort of straight impact of that commodity price change on our silver. Yeah,
notwithstanding the fact no one should be doing their financial models at spot, and no bank is going to do that at spot. Let's just let that sink in for a minute.
Yeah.
The silver revenue has gone up 2.5 times. It's gone up by 1.4-ish billion Aussie over life of mine, and that's the secondary commodity. Copper has gone up pretty materially as well. We use 9,260 and we're at 13.2.
I think that was 6.1 or 6.6 in the earlier scoping study.
6.6.
6.6, yeah, and now we're solidly above 8. Again, if you just do that straight, cut, replace with the new commodity price.
Yes. Okay, Matt. Before we get carried away and before we get in trouble, because that's not what we're here to do on the podcast, right? We're an inherently conservative bunch. It's important to note that there's, what we're doing is effectively timesing revenue by commodity price changing. And we're saying, here you've got a base case, here you've got the current situation, which is, we make no comment about whether or not that's likely to continue, right? There's a few questions here, which is, how do investors make decisions based on these numbers? How are banks going to make decisions? And how do we deploy our capital? And what is sensible? And the way I see it, I think, is that we put out numbers which are very conservative before. $30 an ounce silver versus 85. So you get 2.5x roughly. And 9,260 copper versus 13,200. Now, what goes up can obviously come down, but I think what we're seeing is a fundamental shift in the commodities paradigm. You're seeing a move to, obviously, precious metals. You're seeing that rebasing of the gold-silver ratios, especially in copper. You've got limited ability for supply to react to demand in a fairly tight but very large market as well. And what it says to me is that, even at the very conservative numbers we put out before, you've got a project which remains pretty robust. The IRR, the internal rate of return, remains above about 30%. And the net present value, roughly, post-tax, significantly above a 1-to-1 NPV to CapEx ratio. Now, we've put out spot numbers before, sort of showing, even at materially lower than they are today, that sort of doubles and triples as it goes up. As I sort of kick myself for doing sensitivities plus or minus 20%, but you can only do so much, right? What does this mean?
Well, I think from an investor point of view and indeed from Coda's point of view, when it comes to commodity prices, you probably mainly just need to think about it in terms of, has the floor shifted?
Yeah.
And if you think it has, and I think we've got our opinions internally and they'll probably be reflected next time we publish, then that is probably the number you should be using as your go forward case, or whether you're looking at investing or, in our case, looking to publish a number. But the really important thing to think about from the point of view of Coda specifically and Elizabeth Creek is that, as you say, all we're doing here is dropping in a new number. Mines don't work like that.
No, they don't.
If the price goes up by as much as it has, that changes not just what comes out the back end in terms of dollars, but what goes in the front end. Because a given block of ore may not be viable under the previous paradigm, but may be viable under the new commodity price paradigm, which means potentially your mining plan has to change. Generally speaking, you would assume you would get more tons at a higher commodity price, which means more revenue and ultimately higher NPVs and IRRs. Now, that is a big part of the work that we're going to be doing over the next couple of months through updating our mining plan, through updating our resource to account for new copper equivalent calculations and things like that. It's basically essentially what the PFS is determining how many tons can we actually profitably mine out of this area and how do we do it. So in terms of an implication, that's the big one.
Yeah, and at this stage, what you're effectively doing is trying to come up with an estimated value for the project that works on solid technical foundations. You can be too conservative if you run your models at $2,000 copper. You're killing a project which flagrantly works at $10,000 copper, which is materially below the $13,200 copper spot price. So you can be too conservative. But really what we're looking to do is say, okay, on a reasonable range of assumptions and with some sensible sensitivities on this, we'll include, for example, CapEx and OpEx contingencies. Does the project work? And based on the numbers we've put out and based on the last scoping study, unambiguously, this is a project with solid foundational economics. The spot price of these commodities has gone up 2.5x for silver and about 50% for copper. It's a phenomenal increase. And that, I think, just strengthens the investment case. And that's before we talk about cobalt,
Yes.
which has gone up to $53,000 a tonne.
Yeah, it certainly went through some doldrums there, but yes, as of this morning, solidly over 53, and we're still working on it. We're trying to get it. We've got a couple of irons in the fire. I know we've said that before. It's still the case. We try one thing, it doesn't work. We try something else.
Yep.
Eventually, we're going to put a number out for cobalt. It's just a matter of which one we come down on, which one we're confident about.
Yeah, and whether or not it makes sense within the overall flow sheet as well. So we've got to go through those trade-offs.
Yeah.
Is it worth the incremental cost?
Exactly. However we extract it, we'll have a capital cost associated with it, and we'll have an OpEx. So we need to do that maths, and we need sample to do that, and we have drill rigs in the field providing that sample. Yeah. So it's slow, but it's happening.
So to do a quick summary, holy moly, the commodity prices have just gone insane. That's great. That's great leverage with Coda. That's offering and strengthening, I believe, our investment case. But we have a lot of work to do, and it's an exciting time. We've talked about pre-feasibility studies a lot on this. We've got drill rigs in the field. Next steps are finalising that program, end of the month, roughly.
Yeah, give or take,
Give or take. Yep. Then getting that fast into that big re-optimization. We've got to look at the resource, redo those blocks, look at the commodity price assumptions, look at what then that feeds into the mine plan.
Yeah. So I think the first batch of samples and geotech samples have gone to the lab.
Yeah.
Second batch will be this month. The third batch will be the last thing we do effectively at the end of the program. It all has to happen in a particular order. Unfortunately, it has to go to geotech first before it can go off to assay. And, MET obviously comes. We can't do a lot of MET until we know what the grades are. So assay has to come first. But we're doing everything we can with all these samples. So unfortunately, you can either do a lot more drilling or you have to do everything in sequence. So it's taking a little longer than would necessarily be ideal. But it's just a matter of deploying capital smartly. Yeah,
absolutely. I think we've got the optimal sort of number of rigs versus the cost of having the rigs in the field.
Exactly.
It's not a particularly long drill program in the grand scheme of things, and we'll get a lot of sample, a lot of information, and that will mean a lot of news flow, which I'm told reliably that shareholders quite like. So exciting times, really exciting times. Again, I wouldn't draw too many conclusions other than, wow, this is kind of cool. This is new information. We've been talking about copper doing this for a long time.
Yeah. I mean, I think, I'm not going to pretend that we're, the world gurus on copper, but as you said, you can just look at supply and demand, and it had to eventually, the price had to come up. Silver, I don't think anyone, well, certainly neither of us, quite knew it was going as high as it's gone.
No.
But, I'm not going to complain.
Though in my own investing, I've been out there looking for good leverage to silver, and I've bought a few. So, and again, I think Coda offers decent leverage and exposure to silver, especially as an interesting byproduct, because copper has such a strong fundamental demand profile. You've got all that lovely upside from silver. Now, commodity pricing can go down as well.
It can.
And I think that's an important thing for people to understand too. But you're talking about two very large, deep liquid markets. And that gives me a lot of confidence that we're moving in the right direction.
Oh, well, on that note,
thank you. This was the silver edition. We'll be back with a bit more of a serious look at next phases in the project soon as well. We will sort of get through that. And as the news flow comes, we'll obviously do short updates along the way. Thank you. Thanks, everyone. Cheers.